title of the presentation: permanent benefit of R&D tax credit and energy efficient building tax incentives. Also quickly mentioning that if we have time, we're going to cover some things, other things that can be done to accelerate depreciation to maximize ROI on real estate properties in particular, and some other depreciation space issues as well. So next slide, please, Sean. Okay, a little bit of an outline here. On the R&D tax credit, we're going to, R&D in general, it's going to be deduction as well as credit. We're going to talk about the following topics: R&D tax matters, tax law changes that really have affected deductibility, and a lot of taxpayers have just been really, really harmed financially by that change in law. And then long-term value from the R&D tax credit itself, and sort of decoupling the two, the deduction from the credit, and really thinking about them. They do tie together, but they're also separate. Energy efficient commercial building deductions, 179D. Most accountants that have been around tax have heard about 179 lots of times. We're going to actually mention that if we get into that last portion of our presentation today. But 179D is a very specialized area that deals with energy efficiency in buildings, that allows for this very valuable acceleration of deduction. And a lot of people just don't know much about it, even though it's been around a long time at this point. And then additional depreciation for real property and what we can do around that. Next slide. Okay, so we're going to start with the R&D tax credit. I hope that's helpful. What we want, by the way, we didn't announce this to everyone once everyone got in the room, but we do want you to just go ahead and please feel free to interrupt with questions. The more interactive it is, honestly, the better the conversation is. So please don't sit on your hands. You can put it into the text box, the chat box if you like, or just unmute and say, hey, quickly, Brian or Sean, I've got a question about that. We'll field it on the spot. Okay, so please feel free to make it interactive. We'll appreciate that. Research and development deductions historically. So I won't spend lots of time on this, but I do want to start with where were we before this tax law change. So the deductibility is governed by a code section that's been around for a long time. It goes back to the 1954 Internal Revenue Code. We're under the 1986 Internal Revenue Code that came into effect under the Reagan presidency. And so if you see citations to the IRC, it'll be of 1986. Everything has happened while it's been significant. It was not the kind of reshaping that happened in 1954 to retitle the code as of 1954, or in 1986 that happened to cause us to call it the code of 1986. But to start with, the deductibility has allowed for immediate deductibility to begin with of research and experimentation types of expenditures and costs as they were incurred by taxpayers. And I've worked in the R&D tax space for over 35 years at this point in time, might be 36 years since I started practicing at this point in time. And I've had only a handful of clients over all those years that chose to capitalize as opposed to immediately deduct. And same thing, like if someone says on your personal return, well, yeah, you can deduct that $10,000 amount right now, or you can wait and spread that over time and deduct it over 10 years. Which are you going to take? Well, save me the money today, please, right? Let's take the deduction right away. So most taxpayers that, in my experience, and I've touched hundreds, if not thousands at this point in time, have chosen to deduct immediately unless there was a really specific circumstance. And I've had a few over the years where it just made sense. They were trying to manage alternative minimum tax or something like that. And so we chose to capitalize some of it. And then we had options on how we do that. Research and development tax credits historically, they go back quite a long ways, not as far. They don't go back to 1954, but they go back to 1981. And the credit got started back in 1981. Its history was kind of consumed with expiring and then being reenacted, and then expiring and being reenacted. But through all of that time, since the code was enacted, there was only one period where Congress actually let it lapse and didn't reinstate it retroactively. So in that year, that time frame in the 90s, there was a half a year for calendar year taxpayers that they got half a year worth of credit on that tax return, and the same thing the next year when it came back into being. So every tax return had an R&D credit on it. It just wasn't for all of the expenditures during that period of time. So that's kind of it that I wanted to cover on this slide. Any questions about it historically? Keep moving. Okay, keep moving. So what happened under the Tax Cuts and Jobs Act of 2017? This is the Trump era tax cut that was massively taxpayer friendly. It helped in so many ways. But what I can tell you is the House Ways and Means Committee chairman was Kevin Brady during that time and for a long time afterwards. Kevin Brady happens to live in the Woodlands, Texas. He happens to go to church where I go to church. His son went to school with my son, and I know him, and I've had some conversations with him about this. And part of what went into this is, and these aren't Kevin's words, these are Bryan's words, and a lot of me kind of thinking about, well, what happens on Capitol Hill when you're trying to get things done? If you're going to have billions of dollars of tax benefit going out the door, there may be some things that are done to sort of dampen that and offset that cost when the Congressional Budget Office scores it up, right? So one of the things that happened was around the deductibility under Code Section 174 of R&D costs. And it was a sleeper provision. What happened is it had a 5-year delay before it ever came into effect. And it really surprised everyone, because when that came, as 2021 was coming to a close and 2022 was approaching, Congress was working hard. There were both sides of the aisle, lots of agreement on wanting to fix that so it didn't become a problem where people had to no longer deduct and wait to amortize those costs over an extended period of time. And there were a number of bills that included provisions to try to fix it. But what happened is that those provisions never got passed, and the legislation essentially had, you hear about sunsetting legislation. This was sort of a sunrise where all of a sudden that legislation that had been passed 5 years earlier became effective on January 1st, 2022. And it truly caught everybody off guard. All the pundits that I was reading and following, all the big major firms, the law firms and the accounting firms that have people lobbying and up on Capitol Hill all the time, we're all saying, don't worry, it's going to change. This won't be the law of the land. Well, here we are. We're almost midway through 2024 and it's still the law of the land. So why are taxpayers finding this area so difficult to navigate? It's super costly. I can give you an example on a no-name basis of a medical device manufacturer and designer in Texas that told me face to face, they said, we're a partnership. If we do the tax distribution that will be required to cover all the tax that is being pushed out because of this amount that we're capitalizing and pushing out in additional taxable income, we will literally go bankrupt. There's not a bank in the country that will finance us to pay our tax bill out as distributions to our partners. And we don't have enough cash to be able to distribute everything that the agreement actually says that we're supposed to distribute out to everyone. So I hope that puts it in perspective. That's just one of many, many examples of how painful this has been. I think that the previous comment was you only get to deduct 20%. Really, the first year, you only get to deduct 10%. Because it's a 5-year amortization period, assuming that you've incurred all of your costs domestically. It's a 5-year amortization period that spreads across 6 years because you have to use a half-year convention. So you really only get, if it would have been 20% in the first year, well, you only get 10% the first year. So if you spend $1 million, you're only getting $100,000 deduction. I mean, it's really painful. It causes a lot of additional taxable income. So that's why taxpayers are finding this area so difficult to navigate, because they need to innovate, they need to improve, they need to create products and processes that are better than their competitors to keep driving top line dollars, but they're being punished. And it's when that law changed, it reversed all those years of history of trying to incentivize that through immediate deductibility and this extra enhanced R&D credit that offsets dollars of tax liability. Again, I'm going to pause and ask if anybody has any questions at that point. I think I might have seen something pop into the chat and I'm not able to monitor while I'm talking.
Nothing yet on the chat, Bryan, other than we're getting some people giving us contact info, and I would encourage everyone to do that as well.
Okay. Okay,
Dorothy,
Sean,
I'd like to welcome you as well to the group. Thank you for joining.
Okay. So here's a really interesting question, and I want to share some thoughts and insights from having helped so many clients through this process so far. So how can taxpayers comply without having these massive ramifications? Well, the answer is you have to kind of thread the needle pretty carefully in order to do it. And what I'm going to tell you is that Code Section 174 that captures the deductibility sides of things, it's actually much more inclusive than what qualifies for the credit. The credit has 3 categories of costs: wages, supplies, contract research, actually a 4th, computer leasing cost as well. So for these 4 categories of cost, all of those are included in what you can deduct or not deduct or deduct now or deduct over time. But there are a whole bunch of other things, like if you're spending money to establish patents with your attorneys, those costs are part of your R&D. Depreciation of R&D equipment is part of your R&D. Overhead gets allocated as part of your R&D. There's a whole bunch of stuff that goes into it. A bigger bite at the wages. You have to use box 5 of the W-2 instead of box 1 of the W-2. So there are all these things that can cause this to be a really, really large add back to taxable income. And so what's my practical advice on how to keep it, from being such a massive ramification? I think it's do a good job of really taking a look at what's passing through your general ledger that's going to end up in your tax return, but then really tap it down. If you can come up with reasonable arguments that say that's not really R&D, we weren't really still experimenting, we weren't really still in the unknown at that point in time, I think you need to lay those kinds of arguments out so that you can stop the bleeding and not have so much get added back to taxable income. I can also warn you on the other side of it to kind of play devil's advocate on behalf of the Internal Revenue Service. If you've been clipping along for years and they can see you do R&D, you're an engineering firm, you're an architectural firm where you're designing things all the time, you're a software development company, suddenly there's no development showing up on your tax return anymore, that's a giant red flag, and you're instantly in the crosshairs for possible examination for that. So I wish I could give you bright lines, but I can tell you that we've been pretty proactive and pretty creative in helping our clients figure out how do we make sure that it isn't this much that we have to add back to taxable income, and instead it's only this much that we have to add back to taxable income. And it just takes really rolling up your sleeves and working through it and being creative, being honest, and then, making sure that you don't just think it through, but you actually document it, like you write it up. What is it that we're arguing here? So that 2 or 3 years from now, if we do get audited, we already have the arguments established. All right, I'm going to pause for a moment and see if anybody has questions about that.
Any questions for Bryan here? I haven't seen anything yet on the chat box. Bryan, this may not be in the right order in terms of your presentation, but I'm just curious. I have a client that goes back and forth on whether they're better off having someone classified as an employee or as a consultant, and I know there's a difference in how that affects the R&D tax credit.
Right. If I only answer that from the point of view of the R&D tax credit, they're better off to have that person be an employee, for a couple of reasons. Number one is you get to include 100%, up to 100% of the employee's wages in the calculation, whereas you can only include up to 65% of a contractor in the calculation. You have two people with the exact same credentials, even look alike, and one's getting a W-2 amount for $200,000, the other one's getting a contract payment on a 1099 for $200,000, you're going to claim 35% less on the contractor. But the other reason is that, contractors tend to cost more, right? And that's the reason that Congress put that piece into the law, is that when you're paying a contractor, there's probably a profit added into that, right? It's not just what their wage would be. There potentially are other costs that are getting passed through, travel, meals, whatever, that they've bundled up their own overhead that kind of put it built into their rate, right? So Congress just said many, many years ago, 65% of contract research goes in. So, but that's not the whole story. I'm also a general tax partner, and I do lots of other things, M&A work and private equity at the fund level, as well as portfolio companies and things like that. There's something called the FICA tax. Everybody's aware of it, but if you've got an employee, this is the reason that typically there's a war between employers wanting to call you a contractor and actually calling you an employee, and why wage and hour type audits happen and things like that, is that there's up to a 15.3% tax on the employee, because we're funding the Social Security and retirement and health insurance systems, right? So that's a completely independent question of what the R&D tax credit ramifications are. Is that helpful, Mark?
It does, yeah, and it kind of highlights why that gets to be a bit of a quandary sometimes, so I think it just depends on the situation, what's better for the company and the employee or consult.
It is. And if you've looked into it, you probably already know this, but kind of the key on that whole employee versus contractor is really control. To the extent that the person paying the wage or the whatever remuneration there is, whatever you want to call that, whoever's paying the remuneration, if they have control that says you need to be here during these hours, you need to use this computer, not your own computer, provision of tools, that kind of thing. When it gets down to, we call the shots, we tell you if you get to take your vacation or not, it's leaning very heavily towards being an employer versus a independent employee versus an independent contractor.
But not in California.
Okay. How is that, Ruben?
In California, there's a 3-point test And the middle test is, do they do the same type of work as the business? So if an attorney, we had a presentation this morning, if an attorney hires another attorney to do legal work, it's probably an employee, irrelevant of it, because AB5 and the, and the 3-point test comes into play.
Very interesting. So yet another way to indicate kind of that sameness and control almost. Yeah.
Well, basically, it's a 3-point test, and it talks about control, it talks about whatever, but it's all three. It's not any one. And the middle one, completely blows away, the 20-point IRS test.
Very good. Thank you for sharing that. Very
You're
interesting. Anybody else? More questions or comments? All right. I'm going to jump into the next point there. Long-term real value, even if Congress doesn't fix this problem. So what I'm talking about here is the R&D tax credit itself. And what I'll share is, and I'm sure many of you have felt this or seen this, read about it possibly, is a lot of companies that do R&D and really need to are kind of having they're trying to thread the needle, right? They're trying to say, well, maybe we don't really do R&D. And especially companies that haven't claimed an R&D tax credit before are looking at that and saying, oh, well, that credit sounds pretty good. That's going to offset our tax liability. Well, wait a minute, this thing where you're going to have to add all this back, that sounds terrible. And we just don't want to do it. The issue with that is that there's a great deal of exposure. Code section 174 is independent of code section 41. 174 deals with the deductibility. Section 41 deals with the credit. They're independent code sections. They both you have to look at the rules and apply them independent of each other. Code section 41 does leverage off of 174 for part of its testing, but it's not, if you do the one, you have to do the other. You have to look at your facts and circumstances and apply the law in both cases. And so the problem, really here is like, okay, what's the long-term value? If someone just chooses to kind of bury their head in the sand, so to speak, and not claim the R&D credit, I mean, I've put together a 20-year NPV model that is, going to have too small of numbers to throw up on the screen and share with everyone. But with really not a very big company, very, pretty modest numbers, it can turn out to be a, $600,000-$700,000 NPV benefit using like a simple 8% discount rate in today's dollars over a 20-year period of time of actually claiming that. Whereas if you say, well, we just don't do that, well, you're always at risk that the IRS could come in and say, well, yes, you do, and you're negligent because you knew that you did, and you chose to ignore the rules. We're going to go back and throw all that back into taxable income, charge you interest and penalties, and you've lost your R&D credit. You can't do it. They're not going to calc that for you and give it to you. So there is risk there. But I want people to just, think about that. If you know that you can get this permanent benefit, because the R&D credit literally is a side calculation that you do. You take those qualified costs, you do this side calculation, and whatever that dollar amount is, it comes over to offset your liability. You either get that or you don't, independent of what you do with your add back to taxable income. So the taxpayers that I see out there that really are struggling with it the least, although they had to swallow really hard several times to get over this too, is they're just like, well, we're just in this business, and right now Congress is sort of punishing us. We just hope and pray that they're going to fix this. But we're going to continue doing what we do. We have engineers that do this. We have software developers that do that, or do these kinds of things. And we're going to do that year in and year out. We're just going to have to do our best to try to, with your help, tamp it down so that it's not more painful than it really has to be. And let's maximize the credit to help offset this additional tax liability that we're having to incur. Okay. All right, next slide. So what's Congress doing about this? Congress they're trying. There's a bill out there, and it's gotten some pretty good press. It's been quiet lately, but it was announced jointly by the Senate Finance Committee chairman, who's a Democrat, and by the House Ways and Means Committee chairman, who is a Republican. Did I do that right? I think I might have gotten that reversed. Anyway, one side's Democrat, one side's Republican, and they jointly announced this legislation that was going to do a number of different things, one of which is to fix this 174 add back to taxable income issue. And it was announced, I think, around January 12th, January 14th, something like that, with full, full push by both of them saying, Senator Wyden saying, I'm going to do everything I have to accelerate this, to get it all the way to the president's, but into the president's hands so he can sign this into law. And I'm going to pull out all the stops. And both of them said the same thing. And then it kind of went quiet in the House. The House Ways and Means Committee didn't do anything with it. I kept checking. My team was checking. And they had promised that one of the things they were going to do is to kill the employee retention credit as part of this effective January 31st. Well, January 31st came. I'm looking. There's no movement. I checked in the afternoon. I went home. I came back the next morning. And lo and behold, they did pass it overnight. It was like 257 to 70. It was a strong bipartisan support in that bill. It's been mostly sitting and languishing over in the Senate. There's disagreement between Senate Democrats and Senate Republicans as to certain aspects, especially around the enhancement of the child tax credit. And so it's just sort of stalled. And so with each passing week, I feel like it's less and less likely that it's going to happen and go back and be fixed retroactively, which is what they plan to do, is make it effective with this ability to deduct as you go in 2023 and do a catch-up calculation as well. And so I'm thinking it's starting to look like it's probably going to be after, start leading into this last bullet point. I think it's most likely it's going to be after the election happens. It's just so hard when there's an election year to get, something controversial pushed through. And I just feel like there's so much, there's strong support for it. I just don't know if there's enough oomph in the sales of either side of the aisle to really get it fixed before the election happens. So that's really my final comment on it, I think. Sean, next slide.
Sure.
Okay.
I guess, should we pause for any questions or comments before we switch gears?
I think so.
Yeah.
Look and see if there's anything in the chat. It's quiet.
Nothing here.
Okay.
Okay,
Well,
Sean,
I
I think
guess
you're up.
I'll get started here. So yeah, I'm here to talk today about the energy efficient commercial buildings deduction, more commonly referred to as Section 179D. I'd like to start with a little bit historical context. This is still a relatively unknown incentive, but it's been around for quite a while. It's been around since 2005. It was signed into law during the Energy Policy Act of 2005. And it was originally to incentivize building owners to build and renovate their existing buildings with more energy efficient features. So this was then expanded in 2008 to include the allocation of the deduction to designers for government-owned projects. Now, through those years, it was never made permanent, so it was always up for renewal through Congress and the Senate. But in 2020, it was finally made permanent in law with the CARES Act. And the big news was in 2022, in the Inflation Reduction Act, Section 170 was enhanced greatly. So what changes were made to the Inflation Reduction Act in terms of Section 179D? So for projects that were built prior to 2023, the maximum amount of deduction you could claim was $1.80 per square foot. We see after the Inflation Reduction Act, all new projects, the maximum deduction is $5 per square foot plus an inflation adjustment. So for example, in 2024, that maximum amount is $5.65 a square foot. Now, they also increased the pool for the allocation for designers. So it used to be just for designers. When I say designers, I mean engineering firms, architecture firms who work on government-owned buildings. After the Inflation Reduction Act, they opened that up to tax-exempt building owners as well. And a really important kicker here was this used to be a lifetime deduction for the building. So if you built your building in 2010 and got the $1.80 per square foot, no matter how many upgrades you've done to the building, you can never go back and get Section 170 again. Now we see that the deduction resets after 3 or 4 years, depending on if you're the building owner or if you're a designer. And the calculation methodology stayed relatively the same. They did add a before and after energy reduction metering program, but we're still waiting on some IRS guidance on that. So What is Section 179D? It's a tax deduction that's available for installing energy efficient systems into a commercial or a high-rise residential building. And it looks at three specific systems. The first being your HVAC and hot water systems, interior lighting, and then building envelope systems. And what's our projects are good candidates for Section 179D? Obviously, new construction is great because it's going to impact all of the three eligible systems. So that's a lot of depreciation that you could be claiming anytime you're building a new building. Another good project is renovations and retrofits to existing buildings. Now, the caveat there is you must impact at least one of those eligible systems. So a project where you're just going in and redoing the carpet and just sprucing up the interior would not be a good candidate. However, an LED retrofit is a great candidate for this project. And our typical rule of thumb is the improvements must touch about 20% or more of the building in order to have a decent impact on its energy usage. And then lastly, additions and expansions are great projects for Section 179D. So who can claim Section 179D? So there's actually two buckets, and I'll speak first about the tax-paying building owners. So this is good for any commercial buildings, any high-rise residential buildings. And when I say high-rise, I mean 4 stories or more. And that's just due to how the ASHRAE code is set up. And then the third caveat is the building must be conditioned. That can be heating and or cooling or both. I know in Arizona, you're going to have cooling no matter what, but some of the northern states, we see just heating only buildings that do qualify. And we can actually look back at any projects that were completed construction all the way back to 2006. So we don't have to do the study when the building is placed in service. You can always look back and do the study then, and you would just place that on your next year's tax return. And the benefits of doing Section 170 is the accelerated depreciation deduction. It also pairs very well with cost segregation. And the second bucket I mentioned are designers. And this is for anyone who creates the technical specifications of installation of energy efficient property. The tax code lines out 5 examples. These are architects, engineers, contractors, energy service providers, and environmental consultants. And the eligible buildings that can be allocated are for government and nonprofit buildings. A little caveat here for designers is the only eligible projects are the projects that complete construction in an amendable tax year. The reason being is this deduction is almost like a phantom deduction where they will actually have to go back and amend their taxes to claim it.
And one thing I always like to add at this point, just so people really catch this is, and Sean, I appreciate that you used that term phantom deduction. These designers, a building architect, a building engineer, a contractor that designs the HVAC system or whatever, they're actually getting this deduction, which essentially is depreciation. When you get right down to it, if you're a commercial building owner, you're accelerating depreciation of up to $5 plus per square foot into year 1. These designers get to take that depreciation deduction on their return, even though they don't own the building. They didn't pay for the building, but they get this phantom deduction pushed over to their return because it gets allocated out to them. And again, that's only for government, nonprofit. Think about like schools and military bases, things like that. Lots of building going on. Those are not tax-paying entities. They can allocate, they don't have to, but they can allocate these deductions out to the designers, and it's very valuable. We have a series of clients where we essentially work with our internal tax team or an outside CPA to figure out, well, what are you targeting for taxable income? What do you think it's going to be this year? And then we go work through the buildings and get them that much dollar amount of deduction to zero out their tax liability. That makes sense? It's really a very powerful thing.
Great point, Bryan. Here's just a kind of a summary of kind of what is the value of Section 179D. So we see prior to 2023, we were able to take a partial deduction, which is the 60 cents for one of the 3 qualifying systems. up to the $1.80 per square foot. Now, in 2023 years and after, we're looking at two different rates. The base rate is 50 cents to $1 per square foot in deductions. But the real kicker is the bonus rates. And those are $2.50 to $5 per square foot. But you must meet prevailing wage and apprenticeship requirements. And I'll go into those further. But you can really see that let's take a 100,000 square foot building, being prevailing wage and apprenticeship requirements, the maximum deduction range is $500,000 versus being $100,000. So it's a 5x multiple there for those prevailing wage and apprenticeship requirements. So how is Section 179D calculated? This is the reason that I'm here at Calvetti Ferguson. I'm an engineer working for a CPA firm. This is a very technical exercise. And it does require a PE stamp in order to professional engineering stamp in order to certify the study. So we will actually model the building as it stands today to determine the annual energy cost savings as a percentage. One model will be basically a footprint of the building with all the equipment that's installed to accurately represent the building as closely as possible. And we will then compare it to a reference building, which has the same footprint, but it includes the minimum standards that require for the building code as of ASHRAE 90.1 of 2007. And that's the big kicker there. We're comparing a building built today or renovated recently to a 2007 minimum standard. So how is it? What are the requirements for a Section 179D study? So first off, it has to be a certification and a site visit has to be performed by a qualified individual. Now, a qualified individual is laid out in tax code. And what it means is it's someone who is not related to the taxpayer, is a licensed engineer or contractor in the jurisdiction of where the building is located. Okay. There must be an energy model, and the energy model must use Department of Energy approved software. There is a requirement for a signed allocation letter, but with the caveat, this is only for designers claiming the deduction. So if you're a commercial building owner, you do not need to have a signed allocation letter because you are taking the benefit. And lastly, there's a Form 7205 that basically it's a new form that came out in 2023, and it outlines the deduction amounts and it provides a little more transparency to the IRS, as you're filing that deduction instead of just being a straight line deduction. So here I've got an example of an energy model just to kind of show you how this looks here. Most firms are using eQuest. It's probably the most tried and true software system in this realm. And it's actually approved by the Department of Energy as well. But as you'll see here, we actually build the footprint of the building and model the mechanical systems and interior lighting of it. And I'll touch real briefly on this just to go over the qualifying system. So when we think of your HVAC and hot water systems, how's the building being conditioned? This typically has the largest impact of the energy savings from a modeling standpoint. And we're looking at buildings, boilers, chillers, your air handling units. How are we heating? How are we cooling? And are we affecting anything that's moving the air around in the building? That's how I like to think about it. Interior lighting. This is a very popular upgrade that we see now in schools and commercial buildings, going from those old fluorescent lamps to an LED retrofit. This has a great energy savings from the model, and you might as well be getting deduction if you're making those upgrades. And lastly, building envelope. These are the passive systems that impact the energy usage of a building. Think of your reflective roofs, energy efficient windows, and doors, those sort of things. All right. Lastly, I wanted to talk about the prevailing wage and apprenticeship requirements, because this is something new that popped up. Prior to 2023, this was never something that we had to take into consideration for Section 179D. Now, what prevailing wage requires is that all laborers and mechanics employed by the taxpayer or contractor or subcontractor shall be paid the wages at rates no less than the prevailing wages of the locality. Now, luckily, there is a website we can find those prevailing wages. These are the Davis-Bacon prevailing wages. So any federal projects, they run on the same guidelines. And it's at the www.sam.gov. Now, for Section 170D, the prevailing wages only applies to the construction project. It does not apply to any of the maintenance or repairs that happen after the fact. And there is an important grandfather caveat here. Prevailing wage and apprenticeship requirements does not apply to buildings that began construction prior to January 29th of 2023. Beginning construction can refer to when the ground was broken or the 5% safe harbor rule. That's an important distinction we've to take a look at for even if the building is placed in service in 2025, it depends on when the construction actually started for the prevailing wage requirements. Okay, and then lastly, the apprenticeship requirements. There is a sliding scale of the total labor hours of apprentices to the total labor hours here. In 2024 and going forward, it is 15%. And there is a good faith effort exemption for, depending on the area, if the trade unions don't have apprentices to supply to the job, there's a good faith effort exemption where you can satisfy the requirement by reaching out every 120 days.
Hey, Sean, real quick, there was a question that popped in.
I'm sorry.
And Ruben says, if you want to just install insulation or other, quote, straightforward, end quote, items, is a full study needed, or is it an easier process?
Sure. So if you're just installing insulation, since 170 is capped by either the deduction amount is capped by the total square footage, or it's capped by the cost of the property. So if you're just putting insulation in and it's, you know, a couple $1,000s, it's probably not worth going after the hassle because that's what you're maxed out at. But for Section 170, in order to claim it, you do have to have an energy model completed. You do have to have the site visit and the certification. That makes sense.
We've got another one here that Libby just posted as well. Does the 179D deduction apply to tenants of shopping centers who build their space? So the tenants that are building out the space. Mm-hmm.
So if the tenants, it can in certain cases, if the tenants are installing and have the taxable basis of, let's say, their AC systems, they can go after Section 170 for the cost of that property.
And you'll have to take into account the TIs as well, Libby. So if there's a big tenant improvement that's allowed by the landlord, or the building owner, and it significantly offsets the cost, you're going to be down to just net what did they come out of pocket that's even eligible from a cost limitation perspective, a basis limitation perspective.
Wonderful, thank you. Yes, these days, given the cost of construction and the interest rates being the way they are, I'm seeing a trend where owners of retail centers are either decreasing their TIs and instead of that are just giving longer months of no rent. And therefore the buildings are the build out is really handled now by the tenants heavily. So they are paying and focusing on putting in all the LED lighting and HVAC systems. So if they can take advantage of something like this, I mean, that's significant for them if they know that they could take advantage of this deduction.
Mm-hmm. Good point.
Yeah, thank you.
Okay.
Go
ahead.
Could I ask one more question?
Yes.
Regarding owners of buildings, when owners of an office building or an industrial warehouse or a shopping center, if they build the building and they hire professional construction companies to build this building and they took care of installing some energy efficient features of the actual building, how do they know that they meet the prevailing wage requirement? Do they just go after the construction company for them to verify that that construction hire contractors and subcontractors that are,
That yes, so that's correct. So we've seen it a couple of different ways. A lot of times you need to look at the actual pay applications from the different subcontractors and contractors. Depending on the project level, the building, the construction manager should have those, or if it's on a public project, maybe the architect record would have those.
okay,
And basic track just, it's basically just a spreadsheet exercise to ensure that everyone's being paid prevailing wages, and you're checking the apprenticeship requirements. And there are some, if you just miss it here and there are some caveats, and you can pay basically
It's almost
not really-
a penalty to
correction
make up.
is a better word, correction payment, I believe.
Mhm.
In order to right that wrong, to claim the bonus rates.
great, thank you.
But Libby, there's also not really that great of guidance out in this area. So, do you need to prove hour by hour, that every hour was met, or is it kind of a overall for a pay period? Is it overall for the entire project? There's not a lot of guidance on that kind of thing. So you have to use judgment as well.
Okay. Thank you. Good to know. Thank you.
Well, that's all I had for section 170. If there's any other questions, happy to take them now, or we can talk later on too.
And Mark, while we're transitioning or about to transition, how are we doing on time? We
are good on time. We've got about 15, almost 20 minutes.
Okay. All right.
Good.
Very good. All right. So we're going to pause. We'll have a pregnant pause for just a moment of silence, and just in case somebody has another question on what we've talked about so far. Okay. Seeing none, let's move into cost segregation studies. So the topic here is, what are some things that can be done to accelerate depreciation deductions? And so we're going to talk a little bit and get kind of some practical advice here. A lot of it will be focused on real estate, some of it not. So Sean, if you go ahead and kick to the next slide, I'll handle kind of about the first half of this part of the slide deck, and then Sean will take the tail end of it. Okay, so really, if you're trying to do some things to speed up your tax depreciation deductions, your first line of defense is just to make sure that the CPA that you're using really, really knows the rules for depreciation. I don't know a tax CPA that doesn't know a decent amount about depreciation, but oftentimes they really have gotten more into practicing by rule of thumb. And I'm not trying to throw stones. It's just a lot of volume. A lot of times it's coming at them. And so it's like, oh, well, I've seen this. That's a typical furniture and fixture. That's a 7-year asset. I've seen this before. That's going to get, that's going to be a 15-year land improvement, and kind of feeling their way through that relatively quickly without really referencing the underlying revenue procedure that gives all the guidance for all those different makers classes. There's a lot of nuance to it, what fits into which category, and sometimes just getting enough read into those categories. And I'm looking at it because I can still see the grid that's published in that RevProc in my mind. Is if you get down to enough nuance, you may get something out of a 10-year asset into a 5-year asset and get a much quicker recovery. Obviously, if you can get something out of real property, out of 27.5-year residential rental or 39-year, and move it up into a shorter life asset, that's a significantly accelerated depreciation, including bonus depreciation that you can get on that. So we'll talk that through a little bit. So anyway, really make sure they know those rules. And one of the things, again, just maybe have sympathy for your CPAs, because they oftentimes don't have enough granular data to get you the right answer either. If you've signed a contract for $2.5 million to construct a building, they may just see big chunks of costs that all add up to $2.5 million, plus probably some change orders that overrun costs, and they're going to end up well, that's $2.8 million that was spent. It's a building, and it goes on to as 39-year property on the depreciation report, right? And carve out something for land, a reasonable amount for land that's not subject to depreciation, right? So, that's the first line of defense. Just make sure who you're working with really does know the rules, and they're really kind of working it and scrubbing it hard for you. Section 179, different than what we just got talking about. We got done talking about with 179D. It's a a different a different code section. 179, many of you have heard about that for years. That's the immediate expensing that's been available for a long time, and that's been ratcheted up over years. It's a long time ago it was $250,000. It's 1.22 million, I think right now. It's 1.2 million plus that can be expensed immediately. It's good for new or used property. And so that's something to remember, that it's sort of like bonus depreciation. It does phase out if a taxpayer has had acquisitions or additions during the year of over 3 million, I think 3,000,000 for the year. It starts to phase out and you start to lose dollars of that deduction amount that you can take immediately. The other thing, just to share from a general tax planning perspective, is as a pretty strong general rule of thumb, most practitioners don't take 179 if it's a flow-through entity, if it's an S corporation or if it's a partnership. And the reason is because the real limitation on being able to use the 179 deduction is at the ultimate taxpayer level. And unless they have visibility all the way up the chain and they're doing that 1040 or the 1041 for the trust or whoever's getting that K1 that's coming up, the rule of thumb is don't take it at all. Just get your depreciation deductions and put them into the quickest categories that you can and get them depreciated over time, because you could stall it. And it could just be an excess deduction that just sits at the 1040 or at the 1120 if it's a C corporation, and they can't claim it until such time as they have more taxable income coming up to them to allow them to take it. So it can just be sort of like a net operating loss carry forward, if you will. So if you don't know that they can use it, the general rule is don't take it. Okay. So just wanted you to be aware of that. Then if real property is improved or purchased, the next step is to really think about cost segregation. And some of you on the call probably know a lot about cost segregation studies, and others maybe have never heard about it before. So we want to talk a little bit about, well, what is that? So Sean, if you'll advance the slide. So what is cost segregation? It is a process by which there's a reconstruction of the building, but it's really done sort of in just financial terms, spreadsheets, if you will. It's not as complex, but it's very complex. It's not as complex as the 3D model, the rendering that you just saw Sean going through, and that kind of thing, and building out the energy, the energy usage and comparing it back to that 2007 ASHRAE standard. But it has similar characteristics to it. We have to use a separate database, and it gets touched on one of the other slides here in a little bit. That's called RS means. Anybody that's been in the construction space knows what RS means is. And they update that all the time. It's being updated based on zip code and zones and everything as to what the cost of different materials are to be able to do construction projects all over the land. So the idea is to take buildings that are typically depreciated over this long straight line period. If it's a typical commercial building, it's 39 years, right? You're going to get 139th this year, 139th next year. It takes you almost 40 years before you finally take the last deduction. And for a residential building, say like a rental property or something like that, an apartment complex, it's 27.5 years. It takes a long time before you fully depreciate that. And again, think about the poor CPA that's just cranking numbers late at night trying to get the tax return done. They get a number. It's like, okay, well, I know that's a rental property. They're going to probably set most of that up as 27.5-year property. If they know it's a warehouse or a manufacturing facility or a commercial office building or something like that, they're going to probably set that up as 39-year property, because they just don't have the ability to dig down. And even if they do have individual invoicing, it's really hard to see what really happened. And again, land is not eligible for depreciation, so we have to price that and get that set aside. So cost segregation has this goal to identify and reallocate these assets from these long periods of depreciation over into shorter periods of depreciation. And it goes back to a period, there's a lot of case law in this area. And one of the seminal cases is the Healthcare Corporation of America, HCA case. And if I remember correctly, I think this was before there was there wasn't bonus depreciation going on. They were just like, we don't want this stuck in 39 years. We want this in 10-year, 15-year, 5-year, 7-year categories, so we can get that depreciation faster and get that tax savings sooner, get a better net present value out of this investment through our tax savings, right? So assets commonly fall into 5-year, 15-year that we move them into, but we get 7-year, we get 10-year, we get 20-year assets as well when we do cost segregation studies. And again, it's just to move those out of 27.5-year and 39-year into these faster lives. But there's also a bonus wait, there's more. The famous Ginsu knife commercial. Wait, there's more. Cost segregation accelerates depreciation, and we get this increased cash flow, but we oftentimes get that because of bonus depreciation. And we've got a slide coming up that's going to show what bonus depreciation does. That comes and goes. It's been a lever that Congress has pulled lots of times to spur spending in the economy. When things are getting sluggish, they'll institute bonus depreciation to get people out there buying, hard durable goods, that instead of having to depreciate them over a long period of time, they can take a deduction for it immediately. And like, okay, well, I just spent the money, I needed that, and I get some tax savings out of it right away this year. So that's kind of a good deal. Anyway, so one other piece, that second to last bullet I wanted to point out, is we've done NPV modeling for a number of different taxpayers over the years. And oftentimes you hear a rule of thumb of like 5 years plus. We've actually shown that a fee can oftentimes make sense and not get to where it's even in excess of a third to 50% of the tax benefit to a company. If they're planning to keep the building for at least 3.5+ years, that can be a cost-effective thing for them to pay for a cost seg study to get done, get those accelerated depreciation deductions, and then still flip the property pretty quickly. And there are some give and takes and nuances that we don't really cover in some of the bullets here, but when you do that, you take something that would have appreciated and been taxed at the lower long-term capital gains rates, and part of that will be subject to ordinary income tax rates because of depreciation recapture, and that all gets taken into account in the NPV models that have been built out. And then, as mentioned previously in one of the other slides, it can be tied together with a 179D energy efficient building deduction as well, and you can analyze both at the same time, and that's a good deal. All right, next slide. So bonus depreciation, it's been around for a little while here. Kind of the key is if you're focusing on the center here, from 18 to 22, it was 100%. So if something was eligible for bonus depreciation, you take 100% of that immediately, just like that 179 deduction we talked about a little bit ago. In fact, you can use those two together if you ultimately know who's going to claim it, and it's not going to be a stalled deduction up at the owner level. 2023, it was 80%. We're in 2024 now. We're down to 60%. That's still a pretty big help. You have $1 million that you spent, instead of it being spread out over 39 years, you get 600,000 of that this year. That's pretty helpful to get that deduction right away. It's tapering off. This was part of the Tax Cuts and Jobs Act as well, and it's tapering down, and it'll reset back to and be back down to zero by 2027 if Congress doesn't act. And there is that same legislation I talked about on the R&D front. That a big piece of that legislation also would reinstate bonus depreciation and bring it back at 100% as well, and retroactively. Right now, the law reads with that being back to 2023. Tangible personal property, 5-year, 7-year, types of equipment that would fall into that: specialty plumbing, electrical, furniture, carpet, moldings, cabinets, that kind of thing. One thing to pause and think about is essentially anything that's 20 years or shorter life can be bonus depreciation eligible. So again, all of that we can go through and carve out through this cost segregation process, and Sean's going to walk us through a little bit more granular as to what a cost seg study looks at and what we do. Land improvements get 15-year life, so they're subject to bonus depreciation as well. And just examples of those things: paving, detention ponds, pools, fencing, retaining walls, etc. And then real estate, what's the building structure itself: roof, windows, foundations. Okay, next slide.
Bryan, quick question.
Yes, go ahead.
On bonus depreciation versus 179, I don't hear a lot, especially over the last several years when there were companies that had losses. I've been recording section 179 because it's limited to income, so that if it gets carried forward to the next year and they have a profit, 100% of it can be taken up to the amount of profit. Whereas with bonus depreciation, it creates a net operating loss, and NOLs can only offset 80% of future year profits.
And that depends on the taxpayer. Like you're talking about corporations right now, right?
Corporations, or if you have sole proprietors even.
So
I'm sorry, if you have pass-through entities.
Yeah, so the issue with individuals, if you've got individuals up at the top and you're pushing through those deductions, and if you create a personal NOL either through a 179 or through bonus depreciation, those personal NOLs are significantly limited in how they can be used. I think it's no more than $500,000 in the succeeding year. And we have clients that have had, because of just the size of their business operations, they've had like $15 million NOLs in a single year. They might make 30 million, for 5 years in a row, but they have $15 million loss in 1 year, and then they're stuck. They can only claim $500,000 a year of that each year going forward.
But for section 179, it doesn't create an NOL. It creates
just a
section
separate holding
179
bucket.
carry forward usable 100%. Am I correct?
I think that's right. I actually haven't modeled that or thought that through at the individual level in quite a long time, but I think you're right.
Yeah, so that's one thing I'd mention on that.
Very good. Yeah, thank you. Anything else, Ruben or anyone else? I see something in the chat. Thank you. It's Ruben's comment on the employee versus contractor. Okay. I just hadn't seen that yet. Qualified improvement property is this unique area, and it gets a 15-year life, but it's kind of special. So I wanted to kind of walk through these rules with you. Improvements that are made to real property, it has to be to the interior of the building itself, and it has to be done after the building was originally placed into service. It's not something that you get to carve out as you're building the building. You don't get to have QIP. It's really kind of a renovation type thing afterwards, right? The building's already been placed in service, and then we do this renovation. It does not include expenditures that relate to enlarging the building's footprint. Again, that's almost like new construction, and we're saying new construction doesn't qualify. The expansion of the footprint, elevators, internal structural components. But QIP is eligible for bonus depreciation, and it gets this 15-year class life, right? So even if you didn't have bonus depreciation, at least you're getting that recovery. If it was a 39-year property, you're getting that in less than half the time. If you were just doing that straight line, it's still a benefit, but getting bonus depreciation is a really huge thing. And then renovation projects are just really great candidates in general for cost segregation studies. And we're going to talk, I think, starting on the next slide, about how we start to get granular with it. What's that process look like? Most people, when I talk with them about cost segregation, it seems like sort of a black box, and there's a little bit of a black box element to it, but we want to sort of unpack that for everyone so you understand a little bit more about the mechanics of what's going on. So Sean, if you'll jump to the next slide, I think we're starting to talk about process. Yeah. Okay, so that's yours.
Sure. So how do you claim cost segregation? So first off, cost segregation studies can be performed at any time after the building is placed in service. So if you acquire a building 2 years previous, the cost segregation study is not dead just because you didn't claim it that same taxable year. You can go back and retroactively claim it, and that benefit goes on your next upcoming tax return. Now, for buildings placed in service during a previous taxable year, a Form 3115 or a change of accounting method is required, but the tax return does not need to be amended in order to claim the cost segregation benefits. So information that is typically needed to perform the building study would be the taxable basis of the building, which is going to be your acquisition costs minus your land costs, etc. What you actually have as far as the taxable basis. The property information, so typical demographic information being your address, what type of building use is it, just all along those lines so that we know how to classify that building. Any as-built construction plans are very helpful when we go to the recreation of the building, as well as the renovation budgets / contractor plans if you are renovating the building for qualified improvement property. So it's important that you partner with a professional to accurately perform this study. These studies require pretty in-depth knowledge of construction to accurately segregate all the assets of the building. So a typical CPA just won't have that granular detail in order to actually go in and reclassify all the different building components into their maker's class lives. A big important point here is a site visit by a professional is actually enforced by the IRS. So if they come across a study that did not have a site visit as part of it, that's very likely to be thrown out. So the actual process itself is, once the site visit is complete, the building will be kind of rebuilt component by component via more of a spreadsheet type exercise, not the energy model that we discussed for section 179D. But it's important to do that in order to get accurate costing. And for that, we use RS means. RS means is pretty much the industry standard for construction estimation. And it has information by the year, by the locality, everything for the building. And what the cost segregation actually does is it rebuilds the building and gets a supposed cost that it would take to rebuild that building as it stands today. And then the cost segregation study reconciles that number to match the actual tax basis. So that's exercise that's done after the study is completed.
So let me try to unpack that. We've got a bunch of accountants in the meeting and on the call here. So what we're doing is sort of brick by brick, board by board, wall by wall, floor by floor. We're rebuilding that building in essentially a spreadsheet. What's the cost of that? It doesn't matter if it just got built and it was all built in 3 days and you have brand new spanking cost information. Doesn't matter. The cost segregation methodology has to use the estimated cost and you rebuild it. Then this reconciliation process is to squeeze it down to what did you actually spend or to gross it up to what you actually spent. But that process of building it up brick by brick, if you will, gives us at each step, that's a 5-year asset, that's a 7-year asset, that's a 10-year asset, that's a 15-year asset, that's a 20-year asset, that's a 39-year part of the structure. That's what we do. And then once we get those proportions and add all those pieces up that are 5-year, 7-year, 10-year, et cetera, we now have the proportions so that we can squeeze or expand what you really spent into those same proportions. And then that's what goes into the depreciation schedules. Okay. All right.
Good point. So this slide here, it may be kind of small on your end to actually read, but just kind of wanted to include it as showing kind of breakouts of the different property classifications that you'll see in a cost segregation study. So this is one page of probably 120 pages of different materials, but it's broken down just different categories. So thermal, moisture protection, what the estimated costs are for that, how many doors, how many windows, estimated costs for those, and it's classified into the the 5-year, 39-year class life.
And one other thing I'll just add on that slide quickly, Sean, before you move off of it, is this isn't even close to the granular data. I mean, there are just pages and pages and pages of each board, each linear foot of tile. I mean, it's just pages and pages of it that then throw up and support each of these 39-year, 5-year, or whatever. So it's a lot of data.
Excellent point. I figured that's probably didn't want to show them all the different sheets here, but that's excellent point.
Mark's already falling asleep, so I'm glad we didn't.
No. I was actually going to ask you guys, it seems like if I'm building a new building, it would make sense to get you involved very early to get those assets determined, as it's happening almost.
It's preferred, but we can do it way after the fact as well. It's just
sure.
It's you just have fresher, better data.
Right.
Yeah. I know I think we pressed a little over on time. I think we're almost done. I think we have like 1 or 2 slides. We should be able to get done real quick here.
These will be very quick. So just let's talk about real rough numbers, typical benefits of a cost segregation study. I'd say a nice average is 20 to 40% of the basis of the building gets classified as property that's subject to bonus depreciation. That will range. We haven't seen anything less than 15%. And we have seen studies report up to 65% of that taxable basis. When does cost segregation make sense? Looking at the amount that's charged for fees for the study and the taxable basis and benefits, the minimum dollar amount of basis that the cost segregation makes sense is around $100,000. Now, obviously, there's no maximum dollar limit. The higher the taxable basis, the more benefit the building owner will see from the study. And property really should be planned to be held for 3.5 years or more in order to get the full benefit of cost segregation.
Yeah, because otherwise, if you're flipping it, if you plan to buy, develop, and sell within a couple of years, you're going to spend more money and there are other costs too. I mean, there are some downsides to cost seg. You get some disruption. You got to dig the data up. You need to work with an outside consultant that can actually do the work. There's a site visit required. So if you have tenants in the building, they're going to be disrupted. They're going to be disrupted. Someone have to open up their doors and let somebody come through and take pictures and get measurements and things like that. So it's not worth it if you're going to flip it really quickly. I'll tell you, I actually, that's not 100% true. I have some clients that have said, we know we're going to flip this one, but our taxable income is just too high this year. We want the deductions anyway. That's been rare. I mean, usually they're running it like a finance person would on a time value of money basis. And it's like, it doesn't make sense for us to pay a fee to get this done and then turn around and sell it and pay more, just pay that much more gain in a couple of years. Right. And some of that becomes ordinary income versus long-term capital gain as well. So anyway, just wanted to throw that out there.
All right, this is our last slide, we promise here. But we just want to include just some example results of some studies we've seen, and how we see from the total costs and the percentage of the basis allocation into those 5, 7, 15-year class lives. So first we see manufacturing clients. Now, they had about 61 to 62% of their billing basis be reclassified into bonus depreciation eligible property. And the big difference here is if you're just taking standard 39-year depreciation, your first year depreciation will be $124,000. With cost segregation, they saw $2.4 million. And then the second study here is assisted living facility. Similar here, it's about 24% of the property was eligible for bonus depreciation. And we see the big difference here on a $38 million brand new building. Your 39-year expected depreciation is $988,000, but with cost segregation, $9.2 million. So that's a great ROI right there.
Yep. Wow. Really helpful.
Yeah.
So we've lost a lot of I know we lost a lot of our viewers here, if you will, but let's flip over to our contact information in case somebody wants that quickly. And again, we're going to send this out. I think that Charlotte facilitates that for us as chapter chair, so that will happen.
Yes.
Whoever was registered.
Yes, she will.
Yeah.
I will.
Thank you, Charlotte. So everybody, thanks for the questions. Thank you for letting us come and present. I was a little worried with the content that we wouldn't even get through that last section on cost seg and other ways to kind of enhance depreciation deductions, but we did manage to get through it. I know we went 8 minutes over, so I apologize to everyone for that.
No problem. It was a lot of good information today. Appreciate it, Brian. Appreciate it, Sean.
Thank you, everyone.
Yeah, thank you all.